Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Heads or tails, Don? Heads or tails? It's a coin toss. It's a roll of the dice. Come on, baby. Red 38. Give me a 7, dealer. Folks, if your money, your retirement plan is in a pie charts or us portfolio, that's what you're doing. Your outcome is 50-50, whether you got $500,000 or $1 million at the end of the day. So very, very quick review. Wall Street, the sell side takes your money. They spread it across all their asset classes, their real clients, including the rotten fruit with the good fruit, the muni bonds, the investment bonds, the junk bonds, the stocks, the government bonds, emerging markets, Europe, gold, and now we have private equity and private debt ETFs. Now, it's not just the Ray J's and the Edward Joneses that are the pie charts or us. Everybody knows that, or the Fidelity, the Vanguards. But you even have them in the hollow grounds of Merrill Lynch and the mahogany wood panel rooms of Morgan Stanley. Now, the question I have for you is, do you buy rotten fruit for a balanced diet? I love Don's analogy. So why do you own crappy sectors? Why do you own downtrending sectors or sectors that are in trouble? It's a legitimate question. So let me ask you a question. If you have a, quote, diversified portfolio and you've got some sectors, 30, 40% that's in a downtrend or struggling, does that actually add risk or are you reducing? See, the story is that you're reducing risk. I'm small-minded. I don't see how you reduce risk by holding stuff that's losing money. Okay? So adding downtrending sectors, in my opinion, my small mind, adds risk profile. And that's the crux of the difference between Revere Asset and everybody else, the pie charts or us crowd, okay? Because we believe that you want just enough diversification on the way up so someone lying, Enron, cheating on the books doesn't cream your return. So you only want 10, 12, 15 positions in a few ETF sectors, right? You don't want the whole market, everything. Then you just kind of get a mediocre average return on the way up to 7%. On the way down, it's all correlated. It all goes down together. It doesn't protect you. So on the way down, you want to get out. So normally what we do, we're in the growth stocks, and then when they start selling off, we'll shift to value. And then if the whole market goes, we'll actually move to cash. So when it hits the fan, we don't have diversification. We got cash. Okay? We're very close hitting those levels right now. The market's very scary right now, so I'm going to get into this very quickly. Now, in the last few weeks, because of the market condition, I've ignored the mailbag lately, but today it's important and it's going to tie in to the strategy. So sorry if I didn't include yours. I didn't really want to go into the ones that talk about estate planning or tariffs or economic stuff, except to the extent it affects price. So the tariffs, they may have a effect on price. I want to talk about that. I want to see what it has on price. But other than that, I don't care if you're a Trumpster or a lefty. I don't care. We got to manage money no matter what. Whether it's right or left politics, price is truth. That's the way we manage money. Okay? So if your advisor, and by the way, if you're an advisor and you're at another shop and you're tired of having that, the bear market always comes back apology conversation, or you're in it for the long haul and you're tired of, having the conversation of why you lost 35, 30% for your clients, come on over, join Revere. We can help you with your clients. We can help if it makes sense. All right. Now, do these advisors actually understand what's going on, or is it conflicted? In other words, sometimes they're drinking the Kool-Aid. They believe modern portfolio theory that's full of holes, right? Because of sequence of returns. Google it. All right. Or are they conflicted because the products they're in, they don't get paid unless you get their products? It's a good question. Anyway, so with that, I am going to go to the mailbag, and I'm going to do this very quick because I don't want to grind the show to a halt. Okay. Oh, by the way, we got one in just earlier today. It was for Teddy Bull, or Teddy Bear, actually. It's Teddy Bear right now. It's not Bull because the market's flashing bearish signals. Anyway, Teddy bear got an email this morning asking about Treasury, saying, hey, how come you're in the core money market paying just little bits of interest? How come we're not in the Schwab Treasury money market like Fidelity does, where they automatically do it? Ted answered him back, we always keep a couple trades in the chute so we can trade very quickly in the core. But if we think we're going to have excess cash, we'll move into the Treasury money market. So we actively manage cash. By the way, Fidelity changed their rules this year, so their money markets things are not nearly as user-friendly. So you need to look into that. All right, next one. This is on 325, JZ. Dear Connor, watch your YouTube video, Constructive Digestion Day, 325. Fascinated how quickly you dissect a chart. I've been watching YouTube videos for a while. I'm an avid invested enthusiast, and I find your strategy one of the most accessible, straightforward approaches to investing I have come across. That's why I want to learn more. Are there any books, podcasts to learn to bring you up to speed? Connor, thanks for engaging and being a loyal supporter. How to Make Money in Stocks by William O'Neill, Quagmire's, Maggie's Swing Trader video, Jesse Livermore's books, Dan Zanger's Insights, and Mark Minervini. Actual trading is also one of the best ways to get experience. Folks, you got to do. It's like driving a car. You can take the car test, but until you actually get in the car, drive around, hit a few curbs, just do it small. All right, next one, 326 TT. Father-in-law passed away, needed state advice. He sent this to Don. I had a chat. I hope to meet you in person one day. Fantastic. Never had such a jolly chat with someone I've never met in my life. He's talking to me. Yes, we will take the next steps. You so kindly, unexpectedly advised. He's talking to me. Full service client satisfaction. At Revere, dang dream. Don said, you just experienced why I tell everyone I could never ask for a better partner than Dan Stewart. He is jolly, isn't he? Oh, Don, thank you, group hug.
Oh, right. Dan.
All right, 324.
Jolly.
324, MB. This is after sending me a New York Times article. It's called Your Retirement Portfolio is Like Kindling, and Trump Just Lit a Match. Okay, this is fear mongering by New York Times. That's the left side, I told you. It doesn't help you make money. Okay, here's his comments. I sleep well at night knowing regardless how volatile the stock market is, Revere will be watching carefully, adjusting the ballast in my boat to keep me avoid from getting swamped. Personally, I like the word capsized. But I said, folks, news is supposed to create fear and greed to make you take action. These are not fiduciaries. All right. Last two. Now, this is a very good one. This is actually from a client. He's follows us, whatever, at a 401k, is able to roll it into an IRA directly at Schwab with us. Okay. Since adding my funds at Schwab, it appears that I have not been rebalanced to the Grotection portfolio. This is just about a week ago when the market just started rallying and it looked like we were going to make money. It says it doesn't match what's described in the videos and it's costing me money. Is anyone working to rebalance the new money? My comment. Now, this doctor is paying close attention. Me, absolutely. The whole team is collectively helps assimilate the account. In fact, we have a new special accounts group we monitor until fully assimilated. Therefore, the first accounts we tackle and discuss on every morning conference call is you. You have been brought up more the past few days than anybody. But when assimilating, we have to manage risk. We do not just judiciously go buy the full position size immediately, depending on the market. That would be irresponsible. It can sometimes take 2 months to assimilate, but normally it takes 2 weeks. Looking back in the rearview mirror, it's easy to ask why not bigger. It's 2020, but if we had loaded up and the market reversed, we would have looked really stupid, and it would have been an irresponsible move. So ask yourself, if we had loaded up and the market reversed, how would you have felt? Because that's the specific reference point we started managing money in real time, not a few days later after a nice 3-day bounce. By the way, the day he sent this email a couple days ago, the market reversed that afternoon, and it's been going down the last 2 days. So now it actually turned out to be the right move. At the time, we didn't know. We were just using probabilities. That's the point. Price is truth. All right. Now this is the last one. Let me get a drink real quick. Okay. So this is the last one, and I want to read this very carefully because I want you to ask yourself, is this what your advisor sounds like. Okay. So this is CS on 229. And he is actually a client. He's retired. He actually managed money himself. He was a do-it-yourselfer. And then he's been following us for a while. When he retired, he wanted us to take over and do it. And he put some money with us and followed us for a couple months and made sure. And because he was actually helping a whole bunch of people do it. And he turned over this whole group of people to us afterward, after he confirmed that what we're doing on the videos is what we actually do for clients. In any event, he said, Don, I've been trying to put my finger on what makes you different as a trader. This description by @Casper, this is a very famous trader on Twitter, @Casper, of what it takes at our core to become a successful professional trader. It defines who you are. I have watched you push through illness and boring markets, and you are always there, always faithful, always disciplined. The sentinel on the watchtower, AKA Revere. Let's see, the rest of the, that is why the rest of the team must find and demonstrate. I think they are well on their way. Thank you for who you have chosen to be. Don, thank you so much. That was an epic post. The key word is your email below is discipline. It's an absolute requirement of our process. I'll add another: accountability. We owe nothing less to our best efforts to our valued clients, and we proudly display that accountability every night in our videos. Does your advisor, this is my comment, does your advisor post what he or she is doing every day? Is your advisor a fiduciary? If not, why not? Stop listening to Wall Street. We always say it's okay to be wrong. It's not okay to stay wrong. Now I'm going to read you the definition of this, because folks, and especially if you're a stock nerd, if you're really trading and you're struggling, you need to listen to this and you need to own up. Because look, you could take 10 Dons, you could take 10 people and put Don's knowledge in 10 people. Only 2 of them would be any good because the other 8 would break their rules. The behavioral finance part of investing is actually more important than knowing the rules. You got to follow your rules. It's not enough to have rules. You got to do the rules. If you don't do the rules, they're no good. If there's a stoplight and you run the stoplight, did it work? Not all. It only takes once. All right. Now, this is the email. This is the Casper tweet that he said. It said, I instantly became profitable when I realized this. Now, I'm going to ask Don this question after I read this. I'm going to ask Don, when did this, I know the answer, but I want the listeners to hear, when did this happen to Don? Okay. I instantly became profitable when I realized this. If you're tired of feeling like a fraud with every trade you enter, listen up. Your biggest obstacle is not the market. It's your identity. You can try every strategy, buy all the courses, and still sabotaging yourself because you never decided who you are at the core. Your actions flow from who you are, who you believe yourself to be. If you believe yourself to be a hobbyist or a gambler, you will trade like one. If you believe yourself to be a disciplined professional, you'll handle every aspect with care. The moment that identity cracks, everything else unravels. Most traders skip this step because changing identity feels too abstract. They'd rather chase the thrill of a new golden strategy and hope results magically appear. That's a lie, and it is. The truth is, no formula can beat a weak self-image. If part of you still thinks you're just messing around, you'll inevitably blow it when things get tough. Real change happens the moment you decide with absolute certainty that you are a disciplined trader who follows a clear process. That isn't a casual wish. It's a line in the sand. You do what someone at your level would do, even if it's inconvenient, even if you're bored, even if you just took a losing streak that stings. You act in line with your new standard instead of making excuses. You are your return, your performance. Ask yourself, how many times have you promised to get serious only to revert to your old habits the minute something goes wrong? That's not a strategy issue. If you never fully adopted your identity as a committed trader, you never fully as a committed trader, you still leave an escape hatch for the lazy or reckless version of yourself. Your beliefs about who you are set the ceiling for your success. If you can't see yourself as the kind of person who religiously logs every trade, studies the data, and adjusts systematically, you will bail the second you feel uncertain. It's why so many people stay stuck in cycles of random experimentation, constantly searching for the next big thing instead of perfecting a single approach. Stop lying to yourself that new piece of software or the right mentor will fix your results. If you haven't shifted your core identity, you will sabotage every opportunity you get. If you find a way to confirm your underlying belief that you will find a way to confirm your underlying belief that you're really not cut out for this. So draw the line in the sand. Decide you're the type of trader who does the boring essential work and never makes excuses. It's not a magic trick. It's a commitment that changes every choice you make. The moment you embody the identity, your entire approach upgrades. Your risk habits, your journaling, your reaction to drawdown, it evolves to match who you claim to be. Either you stay stuck in the belief that you're just a dabbler, or you adapt a new self-image that refuses mediocrity. That is the single biggest factor from real consistency. So folks, do you do that kind of diligence? Don's screening stocks 2 hours before the market's ever open. So are all the guys. They've already figured out their strategy before the market ever opened. Are you doing that, or is your advisor just asking you to play golf and taking you to lunch? Don doesn't go to lunch when the market's open. Anyway, Don, so when did that happen to you? When did you decide that you were going to become serious hardcore and really put in the work?
Well, I don't play golf either, Dan, but that's because I shoot a 120 every time I try.
So it's really not because you don't like it. You suck.
I do suck.
Well, thank God you can pick stocks, Don.
Yeah, someday I'll have the time. I don't know when that will be, but so the key word in that was evolution, and it really is once you decide who you want to be. But for me, drawing the line in the sand is the journaling and tracking your stats. That's non-negotiable for understanding yourself, your process, and the mistakes that you're making. It really is the statistical analysis. There's a saying from my IT days: you can't manage what you can't measure, and that is you have to be able to measure your success and failure, your win rate, your percent when you win versus your percent when you lose. And that's really the math behind it. It's not that complex once you understand and create a template, a journal, classify your trades, make notes, know where the S&P is whenever you make a trade, so that you're comparing. You can, if you're up 14% on a trade and you're happy, but at the same time the S&P is up 18%, it's not a good trade. We look for something that can do at least a minimum of 2 times what the S&P is. That's our goal. We obviously don't hit that all the time, but that's what stops are for. And so for me, it was really deciding to do the detailed data collection and diving into the stats and doing the post-trade analysis. Post-trade analysis is huge, but the stats are right there with that.
Absolutely. And I'll go you one better. Don actually went out of his own way to make sure that he was right or wanted confirmation. He went out and found a data scientist. That's actually their degree, their college degree, who is an independent, he's not an employee of Revere, he's an independent advisor. And he actually double checks and confirms what Don thinks. In other words, he confirms it in addition to Don doing the work.
Yeah, that's certainly helped confirm some of our process, no doubt about it. But you can't half-ass this. There's just no way. You won't be successful. You're trading. You're in a market against the brightest minds and algorithms in the world, and until you realize there's no substitute for screen time either. But that screen time helps you generate the stats and verify them, so that your opinion, you get, and again, we have a lot of sayings, but it's okay to be wrong. It's not okay to stay wrong is one of them. And that's a huge one today. And that's probably a good segue into the changing character that we saw on the market on Wednesday. We bottomed about 2 weeks ago. There were some decent names outperforming the market while it bounced for 2 weeks. We had various degrees of bearishness inside the shop here. We debated it actively, and Wednesday was a game changer. And really, let's compare dates here on the chart that I'm showing here, which is the S&P 500, and 326.25 looks a lot like 421.22. So I'm going to go back here. I'm going to set my time back 2 years here, and right here, April 21st, 2022. So we started to correct. We bounced, got back above the 200-day moving average, came back below the 200, attempted a second bounce, and failed into the flat 200-day moving average. The 200-day moving average isn't flat now, but it's only going up by about a point each day. So it's essentially flat. That was a big failure, a big negative reversal. Today, we followed through to the downside on Wednesday's negative reversal with stagflation type data that came out with the PCE inflation data, and that was cemented by poor consumer confidence numbers. So it's very possible that this is the beginning of leg 2 down. And we always go back and take a look at the action in the past for similar types of markets. And that's what this most resembles to me right now. We got out of all stocks on 221 initially when we had a big negative reversal. This was the first time we went to cash. We came down, as I said, bounced 2 weeks ago. We reassessed and put some more positions on. But all we really did was form this big bear flag channel, which we came to the bottom of it on Wednesday, broke back below it on Thursday, and really cemented the break today. So,
so you started
we sold a lot.
So you started adding exposure and then changed and started reducing again when the market reversed back down.
Yeah, today we got out of the last 3 of our individual positions for tiny losses or flat or small gains. But we still own gold, we still own silver, and I'm in the process of. I've been talking about this 3% envelope from prior research. That sometimes that first move back above the 200-day moving average, that's all the correction you get, and you go back up. But things changed on Wednesday, cemented the change today, and we're in the process of hedging that little core piece of the S&P 500 exposure. We're 3% below the 200-day moving average right now. We got 3% below it 2 weeks ago, but the slope of the line has been going up slightly, but since then, so now we're 3% below it without piercing the prior lows. But we had, if you look at a 60-minute chart here, you can see the ranges that we've been discussing. We broke above the ranges on the 24th, stayed above them for 3 days, broke back into it. It's very frequent to test a pivot. We tested it, got back above it, failed, and this was closed back below it yesterday again, and now we're back near the bottom of this range again at 5,600. That's a key level, and then 5,500 was the bottom of the correction from back around the 13th of March. We've got 2 trading days left, today and Monday in March. The end of March is typically a bearish. The last couple of days are typically bearish in March because it's end of quarter. I don't know if people are selling in prep of paying their taxes 2 weeks from there or what, but seasonality really isn't playing a big factor in what we're doing right now. That's a secondary indicator. We're always going primarily by what price is doing and the action of leading stocks. We reinstituted the 21 over 21 last week, and they held up pretty well, but the bunch of them are breaking the 21 today. The only surviving sectors at this point are a few financials and insurance companies, oils, and gold and silver. and we still have gold and silver position as long GLD and SLV, along with that small core piece of the S&P 500.
Yeah, man. I'll tell you what, if NVIDIA and a couple of those big names really go, this market it's got a long way to go. It could fall a long way, folks. Don't kid yourself. I mean, we're right at the cusp. We're right on we've broken through. We're through correction territory, right? We're just barely past correction territory.
No, we're not there yet.
We reclaimed it again. Okay.
Yeah, we reached minus 10. We reached minus 10% on the 313 low. We were down at that close 10.4% as of right now. 5604. We're down about 8.8% off the high. So the last 2 days, we went to mild correction on Thursday. We'll go back to moderate correction by the end of the day, because to us, moderate correction is 8 to 12% off of the highs in the S&P 500. And that's kind of in line with what we're seeing in our portfolios. The difference is the S&P 500 can keep coming apart, but we won't. Our downside is less than 1% now of the balance of our portfolios.
Our portfolios are down like 0.3. Mark's down 1.5. We're down much less than that.
That's our balance at risk calculation that we keep for every portfolio and discuss in our videos every night. So that's
actually the more the market goes down, we'll benefit from that. I mean, I hate it for other people that have pie charts.
That's called
writing it down and getting hammered, but.
Yeah, crisis alpha. That's kind of what we it
sucks for people that
it sucks for people that don't follow what we do, but it is what it is. And you draw this line around this 5670 going back to July and August of last year, which we broke below, got back above, but we're piercing that level again. That flipped from resistance on the way up in June to July to support last September and October. We pierced it when we did the correction back in early March, and breaking it again. So again, don't argue with what's going on. Realize this is a big bear flag. We broke through the bottom of the bear flag. We're not going to ignore it, because, and this is that accountability again, Dan.
Yep.
Everybody that listens to our videos should never be surprised by what we say in the videos, because we set keys up for each day, things that we're watching. We review those keys every night in the video, and then we establish new keys for the next session for what we're going to be watching. And, one of the questions was, are we going to have distribution after what was seen as a possible follow-through day on Monday? One of the first things we said, we do not want to see distribution, and we got distribution on Wednesday, and we're certainly getting distribution again today. So it's just a matter of setting the rules, sticking to the rules. And again, you should never be surprised by anything you hear on our videos at Revere, because we've got a solid process. We discuss it every night on the videos. We're all on the same page. Mostly, obviously everybody has opinions. There's various degrees of bearishness. And we'll hear from Teddy Bear, who's been the most bearish in a while, and he's been vocal about it. He's been doing a great job of breaking down and arguing with a lot of big hitters about NVIDIA, but plain and simple, NVIDIA is in a bad stage for if you're a Weinstein stage follower. It's just, you can't argue with it. You can say all you want about how great a company NVIDIA is, but you can't argue the fact that it's in a downtrend based on stage analysis.
1, 2, 3, 4.
And now you've got the 200-day moving average rolled over today.
Ooh.
Yeah, today. Actually, yesterday it did.
But here's the real gold nugget, folks. Listen to this though. It's not just about NVIDIA. Here's what you got to realize. Even if you don't think you own NVIDIA, you own NVIDIA 16 times, and every fund you own probably has NVIDIA, or almost. But if you own NVIDIA, if NVIDIA goes, the entire market is going to go, folks. The NVIDIA is such a big market cap weighted. If NVIDIA sells off, the NASDAQ is going to go, and even the S&P to some extent. So you're going to have to get defensive, because NVIDIA will affect your portfolio if you own stocks. Sorry, Don, go ahead.
Yeah, that bear flag has broken for the NASDAQ 100 as well. I'm kind of drawing it here. And semiconductors, I added a semiconductor short to Grotection on Wednesday, when they failed at the 21-day moving average, Ted and Connor have been shorting this in turbo protection for weeks now and racking up the gains. It's just and it's just putting your opinion aside and going by what the charts are saying.
All right.
That's it for me. I'm going to turn it over to the fellas now, and let's start off with Todd. Todd's going to talk about, I mentioned we still have gold and silver. Todd's going to talk about that sector.
Okay. Yeah, I'm going to start off by looking at the monthly chart of gold, GLD, and just kind of take a look at what's been going on there. You can see we're well into new high territory after a beautiful breakout of a multi-year base in October of last year. Just to give you a perspective on what's happening in the metal market. The next thing I want to look at is the SLV on a monthly basis. And you can see SLV is still, it's breaking out, but it's still well off its all-time highs. So today, what I want to talk about, again, we know we're playing the physical commodities right now with the GLD and the SLV, but also today I'm going to talk about PAAS, which is one of the stocks in the silver mining area. And I'm going to hit on two different themes here. We're going to look at the gold to silver ratio based on history. And then we're going to look at what the current situation is with record short positioning on silver. So first off, I just want to say that the current gold to silver ratio is 90-1. That means it takes 90 ounces of silver to buy 1 ounce of gold. Okay. If you look at that average in the 20th century, it was 47-1. So that would mean that silver would have to climb over 100% from its current levels to get to the 20th century average. Since 1970, the average has been around 54-1. So still a long way to go from the average since the 1970s. Okay. And we've been down as low as 15-1 in the early 70s and 32-1 in the 2009 to 2011 period. So you can see that right now silver is substantially lagging gold, and historically the ratio is still way off compared to what it's been historically. Now, the second thing I want to talk about is fundamentally, we're at a near record short position in silver. Right now, there are 223 million silver ounces that are short at the bullion banks, and that represents about 25% of annual silver production. Okay, so if we just go back to a daily chart on the SLV, you can see we've broken out of a nice cup with handle base, and we're pushing up against that recent high back in October. So we're still in this very nice cup with handle base, and this looks very attractive still, with relative strength rising. Now, if we look at one individual stock, PAAS, Pan American Silver, you can see that relative strength is also moving into new high ground, and this also broke through a double bottom base recently. Now, if you go back and look at the October highs to the January lows, we have a VCP pattern kind of developing here, where you've got the first move from that high down to the low, which is about 24%. And yeah, Don, if you would just draw a line. Actually, yeah, I was going to draw a line from the highs to that low as one particular contraction, which is about 24%. Yeah. And then here recently, we had an 11% contraction from that recent high down to the low. Yeah, exactly. That's about 11%. And then here recently, in this little pattern, we've got about an 8% contraction. So what I'm watching here is for this to tighten up and continue to hold above its 8 EMA with a potential position breaking out of this VCP pattern.
Can I hang on one second? Let me put my Todd Terpeter on there, because that was a little bit complicated for someone that's not a stock nerd. What he's saying is those declines, percentage wise, are getting shallower. Each successive decline is getting shallower. That's more of a bullish sign. That means the selling is being absorbed more and more by buyers. And so it could be a bullish sign and it's coiling. The other thing he said was because SLV, has got a large 25% short interest, you could get a short squeeze. Now with ETFs, it's a little bit different because they can create new shares, so they can alleviate that a little bit versus, with stocks, you've got a limited finite number of shares, but still that's a pretty big short interest. So what he's saying is this Pan American chart could be coiling for a move higher. Go ahead.
As well as silver itself.
Right, right.
The all-time high in silver is close to $35, and we're still, or I'm sorry, it's close to $50,
yep.
And we're still well off those highs. So, and also there's an interesting thing happening, and we don't get too involved in this type of thing, but supposedly on Monday, there's going to be a coordinated effort to create a silver short squeeze by retail investors. Much like the GameStop type situation.
I was going to say, is that a Reddit? Is it? Yeah.
Yep, it's actually a Reddit retail push to really get these institutions to start covering shorts. Now, whether this will work or not, who knows? We're not playing it for that reason, but be on the lookout for Monday to be that coordinated effort to push that to new highs.
Well, remember, the Hunt brothers tried to corner silver in the 70s, and the Swiss bankers cut their knees out. So the bankers won that round. I'm not basically the investment banks. Now they may win this round again, but we'll see. That's why prices trade.
That was the all-time high in silver, and we came close to that back in 2011. So we're still well off those highs, and the ratios are at very low levels. So silver could play some catch up to gold, and that's really the main thing I wanted to talk about. We're also going to talk about AEM as really being our leading stock that we're following in the gold area, and it's currently extended. However, you can see that a lot of these gold mining stocks have substantially outperformed the market and doing very well. And really, one other name that is involved in both silver and gold. There's not really that many liquid silver players, but Wheaton Precious Metal, WPM, they're involved in both gold and silver. So that's another one that looks very attractive and strong and one to watch out for. And that's my segment.
Great stuff, Todd. If they say there's always a bull market somewhere, this is certainly the area that's leading that bull right now. All right, let's take it over to Connor. Connor's going to start off with a nice screenshot. He's going to talk China today.
Yep. Yeah. And what Don just said is, the big Wall Street phrase, there's always a bull market somewhere. And that is usually true. You just have to find it. And that may not always be in U.S. stocks. And we're huge relative strength guys at Revere. What leads tends to lead in the coming months. And one thing that we've seen this year is a shift out of U.S. equities into emerging markets. Now, emerging markets have been dormant for years. And that's just another reason why we focus on relative strength. If you're at a pie chart, RS, and they have you sitting in emerging markets, like just what a waste of time. But now there's been a character shift with money flowing back into emerging markets, and that's when it starts to catch our attention, and that's when we start to get engaged. So that relative, so that performance chart Don was showing right there, that really tells the whole story. You look at FXI, this is China large cap ETF. That's up 18% year to date. You have KWEB, which is Chinese internet stocks, which is up 20%. And then you look at the Qs, which is down 8% this year, which is a huge lag. And then you also have the S&P that's down about 5%. IWM, Russell 2000, is down almost 10%. So you can just see the huge divergence between Chinese stocks and U.S. stocks. And then if we go down to take it to another level, with the indexes up that much, you're going to get outperformance in the leading stocks. And this is kind of the same thing that we talk about when the general indexes are in an uptrend. We want to focus on leading stocks. And that's kind of what you're seeing in China right now. The liquid leader, BABA, that one is up. That one's up almost 56%, leading the charge. And then basket of other names, FUTU's up, 30%, PDD's up 25%. So that kind of tells the whole story there. So if you want to, the viewers, I included most of the liquid best performing RS China names. So if you're watching this, you can just pause it and jot those down if you're interested. But we can go to the charts now, Don, and if we'll start with BABA, as that's the best performing stock. And kind of how I was looking at BABA is whenever there's a big bull market in a certain sector, country, there's always the liquid leader. So when we had the semiconductor bull run, NVIDIA was the name to own. And I kind of view BABA as the NVIDIA for China. And there's a couple reasons for that. One, it's super liquid. This one, trades tons of volume. It's the institutional favorite, easiest China name to get into, and it has less gap risk versus some of the smaller, more speculative names. And so, good fundamentals turning around. And that's how I kind of view this for this play. And a couple of things that I really like about these setups. If you go to the weekly chart, Don, another big Wall Street phrase is the bigger the base, the higher in space. And just as NVIDIA's breaking, could potentially be heading into a stage 4 downtrend. You look at this BABA chart, this is heading into a stage 2 uptrend. And this was characterized by years of neglect in the stage 1 base, horrible sentiment. And then earlier this year, it started to make a massive run. It moved over 70% on the initial leg higher. And, some people may think, oh, it's extended. If you zoom out, you look at the weekly, the monthly charts, it certainly is not extended. This was a $300 stock a couple years ago. And that initial leg higher was also characterized by huge volume, a lot of days closing at high day, positive catalyst, positive news flow, and just, a picture perfect initial move higher. And what I like about this now is it's putting in a 6-week base on super low volume. So, I don't think there's much sellers in the stock at the moment. And it needed to work off some of those overbought conditions, on a daily chart. It was surely extended. It was about 9 to 10 ATR extended from the 50-day moving average, which is historically a spot where stocks tend to take a breather. Now that 50-day is finally catching up to price. This is, just battling right around the 21-day right now. But my view is that 50-day just needed to catch up, and this is putting in a pretty picture perfect 6-7 week base. And my expectation is, I could see this basing for a little bit longer as long as it doesn't see huge distribution and start to break down. I think this is in great shape, and I think it's just setting up for the next leg higher based on the price action. China stimulating the economy, very negative sentiment. Everyone hates Chinese stocks, rightfully so, but there's been a character change in price. We're technicians. The Tate tells all, we're going to listen to the price action. So for China, I think Bob is the number one name there, along with the ETFs. And Don, if you just pull up KWEB, this is the Chinese internet stocks ETF, and just very similar profile. We'll start with the daily. Big move up once it got back above the 200-day moving average, and then now it's just putting in a base, natural reactions. So this one's looking good for now. And yeah, might need some more time in this space, but as long as it doesn't break down as a bull, I think it's doing nothing wrong. And then take a look at that weekly chart as well, Don. And this one looks very similar to the BABA chart, right? Breaking out of a huge stage 1 base. And that is where all stocks usually start their moves out of a stage 1 base. It's just the price cycle that stocks, asset classes go through, stage analysis. And so if this can continue into stage 2, it should see some long runway. So that's BABA and KWEB. And then we can just take a peek at some other ones. FUTU. So I made the comparison that NVIDIA or BABA is the NVIDIA of China. Now FUTU, I'll make the comparison that this is the Robinhood of China. Does the same stuff, Chinese brokerage platform, a little bit less, still very liquid as well, but a little bit less, has quite a high range, like hood, trades big ATR. But this one, again, looks good. Big move up, pulling back, surfing. It's breaking the 50-day today. But this has all been on quite light volume. So I think that's the market just telling you that it needs some more time to consolidate. But the shape of the charts look great. And then one last one is JD. Again, this is another one, strong move in the early part of the year and now setting up in a base. This one's holding the 50-day moving average and looks good as well. And then in that comparison chart, if you just go back in the video, there's a bunch of other China names. I'm not going to go through those right now for time's sake, but those are good ones to look at. Most are in stage 2 uptrends, and on this pullback, it's been characterized by light volume. So that's the China sector. And always when I'm looking at a sector or something, I want to stack all the odds in my favor. And one way to do that is, finding a basket of stocks in one group, because that means that institutions are heading into that area. Just like we saw semiconductors as they came out of 2022, 2023, there was 15, 20 different semiconductors all setting up in virtually the same chart pattern. And now fast forward today, all the semiconductors are setting up in the same way, and that is they're heading into a stage 4 decline, stage 3 topping pattern. So that's trying to find the diamond in the rough, as the U.S. markets are a bit weak right now.
So, folks, Connor basically is saying, rather than a pie chart to us where you just get everything, including the rotten fruit, which is the semiconductors right now. They used to be the winners last year. Now they're the rotten fruit. And China's the good fruit, the fresh fruit. So he's leaning toward China. He's long China and he's short semiconductors. Are you doing that, or you got a pie chart to us? Anyway, go ahead, Don.
Connor, great job there. And
it was.
We're very closely watching this consolidation. I like this is FXI. This is the China 50 index. The 50-day moving average is coming up to the bottom of this base that it's forming right now. And if you like some high octane, there are ETFs 3 times FXI, yin and yang. If this breaks down, yang is the play to the downside. If it takes off to the upside, yin, YINN, is the high octane play on the China 50.
Yin is my up and yang is my down. Is that what it is?
Yep. Yeah, clever naming on those ETFs there. All right, Connor, thanks so much.
I thought those were the panda bears. No, I'm teasing.
They might be. Teddy Bear now. Take it away.
So, yeah, Don did a great segment about getting defensive as the markets pulled back and started correcting again. Todd did a fantastic segment on gold and silver. China. Connor just talked about China. And my segment will be the opposite, shorting. And this is exactly what differentiates us at Revere from the pie charts are us. I'm going to use Dan's trademark or registered term. That this segment, these 4 segments, is exactly what differentiates us and what you don't get at other advisors. So let's get right into it. We only want to be in names long when it's time to be long, and in names short when it's time to be short. And I mean, other advisors, I doubt they're going to be shorting stocks, nor have the skills like us to short them as well. So Connor talked about our semiconductor short and turbo weeks ago on the podcast. I'm just going to quickly go over our thesis and just highlight the progression that has happened so far. So initially, we had this 2-year bull run in semiconductors. Then we had this huge sharp sell-off, and that often indicates that a sector, a stock, or market is potentially heading into a topping process. However, you can't just label that as the end because the rising moving averages. So for the next 5-6 months, the SOX semis ETF just oscillates around, sees one failure at the 50-day, a second failure, a third failure, and then a fourth failure. And Connor, if you guys remember, in William O'Neill's shorting stocks book, typically the best shorts come 6 to 8 months after the actual top, which is right here. And then you have 3 to 4 to 5 failures above the 50-day, which is the red line, before ultimately rolling over. And what happens during this topping process is that the rising 150 and rising 200-day moving averages catch up the price, they flatten and ultimately roll over. And this is the day right here we got short. We had this huge down move on volume, then a tight day into these moving averages. We gapped up, and this is also when NVIDIA reported earnings gapping up. But this was relatively weaker than NVIDIA at the time, and we took it in the morning. And it's been a nice move so far down to these August lows, which is that yen carry trade fear. We had the overall just broad market bounce recently, and semis was a lot weaker, or relatively weaker than the indexes, far below the 200-day moving average, whereas the S&P closed a couple days above. The NASDAQ briefly touched it, and the semis were far below all key moving averages. And here we have it. When the markets continue its primary trend, semis has collapsed, and we are making new lows so far. On the weekly chart, I mean, really slow, and this is just a total downtrend at this point, and we have no idea where this will fall. I can give a couple support levels. 186 is a potential support level, then about 178, and after that, you really could see 150. And Dan mentioned NVIDIA. I also mentioned this on the podcast before. This is another reason why we were bearish semis. It's because NVIDIA is topping out as well, showing a lot of characteristics of the topping process. A failed breakout on earnings here, then another failed breakout on the CES event. Then we had the DeepSeek event with huge distribution, followed by a weak fledgling rally. And then we had another news failure on supposedly amazing earnings. When you have amazing news and poor price action, that is usually one of the best indicators of a topping process, or that you are near a top. And this also came out or broke down from a perfect bear flag as well. So continue on. I want to talk about a couple shorts we took in Turbo yesterday. The first one is pretty much similar to these bear flags we just reviewed. Yes, which is pretty much like a Mag 7 ETF, plus a couple other names like CrowdStrike and I believe Cloudflare, and maybe one other name. In total, 10 names. And this would also had a huge break from the highs, rallied above and got back above the 200-day for multiple days, rejected the flattening 150, and this also broke a perfect bear flag. And now it's looking to test these recent lows around $49. And the thesis was pretty much the same. Tech was weak, semis and Mag 7 just really overinflated into quote unquote bubbly territory, almost representing 40% of the S&P and over almost 60% of the NASDAQ 100 at this point.
If it breaks that 40, if it breaks that 49
area,
it's got a long way to go. It's got a long way to go. Yeah.
And I'm going to show one more trick after this, actually, in terms of technical analysis. And kind of, you can assign price targets, but we don't really assign price targets because nothing is ever certain. But it's just a guide for us on where price can go. And actually, we can just do it on this here, actually, as a case study. If you take this move from the all-time highs to this flag low, that's about 12 points. So 12, not percentage points, but $12 points. If you take that, and with a conservative estimate from the highs of the flag and go down 12 points, you can say perhaps we end up at this 41 level if we do resolve this bear flag, which at this point there's a pretty high probability that we do end up off these chart patterns that we've studied and looked at from the past and previous precedents. So the other short, so we took FNGD, which is the inverse ETF, since we don't have marginable accounts for every client. I was just a short stocks. So the other one was XLF. This is a different type of pattern. It wasn't, you could call it a bear flag, but it's more just a weak rally into a key area. So from XLF, we had a failed breakout, and you'll see that on all the other examples I talked about, most of these bearish moves start from a failed breakout, and most bullish moves, actually, most major bearish moves start from a huge failed breakout from a big base. And same with on the bull side too. You have a failed breakdown, like at the bottom of October 2022, when the market's bottom on the hottest CPI, you had a failed breakdown, which led to this 2-year bull market. So we broke down hard. You can see the volume was elevated here. We started rising, but there's zero volume coming into the market, meaning buyers were not coming in, sellers were in control. And once we got to this inflection point, which was pretty much support turned resistance, and let me make that black actually. You see that we overshot it a bit, coincided with the 50-day, and have moved down so far. When we look at the individual stocks in this group, XLF Financials, JP Morgan also had a weak rally into the 50-day. Wells Fargo as well, big break, failed breakout, rally in the 50-day, rejected. You have Bank of America, same thing, huge failure at the 50. This was even weaker, went below the 200, rallied into the 150 and failed. Then you see private credit names like Carlyle Group just living below the 200, rejecting it. You have Ares Management, another private credit group, and then it's just a couple private equity groups as well. Breaking the bear here, living below the 200, that's never a good sign. And the final one I will show you guys in financials is Blackstone. This is, I think, it's the biggest or one of the biggest private equity groups, managing about $1 trillion or more now, living below the 200. And private equity and private credit really drive a lot of the economy and investment nowadays. And you don't really want to see those in stage 4 declines. So talk about semis, which we continue to have short. We did trim some off on that first leg down. So we still have a piece left there, but we initiated FNGD yesterday. And then FET, which is the inverse 3X for XLF. And they're playing out so far, so good. So we'll see what the markets continue to give us. And yeah. And actually, I want to add one more thing. I've posted about it. I've mentioned it on the video last night. I was emphasizing it. The mega caps concentration is something I've been worried about. I mentioned that we neared almost 40% concentration at the highs when all mega caps are at their respective highs. And right now, before today's down day, they represent about 33% of the S&P 500 and about 54% of the NASDAQ 100. So you can see this is the MAGS ETF. You can see this huge move in the mega caps, and this is just about to break down here. And like what Dan said earlier in the podcast, the mega caps do crack and move all the way down here. I mean, I was trying to calculate an equivalent S&P level, but I kind of messed up on the video last night. Maybe I'll work on it again with the AI and get back to you guys maybe next week. See if we can predict such move looking at the mega caps, because they do hold a huge weighting in the S&P and the NASDAQ.
Right.
And actually, just one last thing. With pie charts, they'll stick you into these mutual funds, and even let's say even the S&P. The problem is in this regime, because of the over concentration in these 7 tech stocks, you don't technically really even get diversification. It's kind of an illusion that there's broad diversification now in the NASDAQ 100 and S&P 500, which makes it even more important to have sell rules and be able to identify what sectors, what precious metals like gold and silver, what international markets are coming into favor and rotating out and into the strongest names, or shorting the weakest names like we are doing.
Right. Folks, what Ted's saying is it's really only about 12 or 15 NASDAQ stocks that really matter for the NASDAQ 100 and for the whole NASDAQ. So you really got to pay attention to some big heavyweights, because if they go, this whole market is really going to take a big dive. So, all right, Don, do you have anything else? That was great, Ted, by the way. Everybody, that was a great segment, all of you.
Yeah, one solution to the heavy market cap weighting is the RSP, the equal weight S&P 500, which has been showing some serious relative strength. In fact, its relative strength line is not quite, but near where it was when it was in the highs last November. despite price being significantly off there. And that's just pointing out to the massive outperformance by the equal cap weighted RSP versus the market cap weighted SPY or SPLG or VOO or IVV. Those are the four main market cap weighted S&P ETFs. That's it, Dan. Take us on home.
All right, folks, listen. You can't measure. You can't manage what you can't measure. Don had a great quote. You can't manage what you can't measure. So as your advisor, or you, if you're your own advisor, are you measuring? Are you measuring this diligently? Folks, look, any time is a great time to come to Revere, but the best time to come to Revere is before the next bear market. And look, I am not trying to fearmonger. We might be here right now. We're right on the correction level, right above correction level. If we break through that 10%, we could go. A lot of times it'll hold right around that correction level, and pull and hold. But every once in a while, it'll go and it'll give up the ghost and it'll break through. And when it happens fast, folks. Bear markets happen. The biggest losses happen in the first 2 months. If you don't have a sell discipline now, you need to get one. And again, I'm not fear-mongering. I'm price talking. At Revere, price is truth. No exceptions. Listen, if you like what you heard, go up to the right hand. Just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. You can just tell your friends, tell a neighbor, put their name and email address in and get the confirmation. It'll send our daily market insight, a 10, 15-minute video. Every night the market is open. We're the most transparent advisor, not in the country, in the world. We're showing you what we're doing. In fact, when clients become when people finally become clients, they follow our newsletter for months and they finally become a client, they go, wow, now I'm really feeling in real time what you're doing in the portfolios. Before it was kind of in the internet ether, it was kind of out there in cyberspace. Now I really get it. Okay. Next to it is a contact us button. You can just send me an email. Dan, I'd like a complimentary portfolio review. I want you to talk about this stock on the podcast or a topic. We'll be happy to. And you can always call us at Old School at 855 Real Wealth. Folks, get your money managed away from the sell side. Come over to a fiduciary advisor that manages their own money, just like your money, down to the exact same price and timestamp. We'll talk to you next week on your money, not their money, your money.
Because now more than ever, it's not how much you make in the market, it's how much you can keep.